Hello and welcome to the Money Show, your one-stop destination for all your personal finance queries. I'm Kavita Thapliyal and we have lined up a show for you today where we'll be talking about your investments and your insurance. Our focus today will be on the new surrender value norms or calculation that's been regulated or that's been announced by the regulator, implemented from 1st of October. So we'll be focusing the first half of the show on this particular topic, and we will also answer your mutual fund portfolio queries live on the show. So just in case you want to send across your queries or you want to get your live financial planning done by our experts, you can WhatsApp us your queries on our WhatsApp number. We also have an email ID where you can send across your questions. So 8657974571 is the WhatsApp number, and the Money Show at etnow.tv is the place where you can send across your financial investment details so that our experts can go through it and direct you for your financial goals and suggest you the right kind of strategy. All right, but then let's begin the show and let's talk about the new calculation for surrender value that's been implemented from 1st of October. I have with me Amjad Khan, Executive Director, Employee Benefit Practice, International Business, Anand Rathi Insurance Brokers. Amjad, good evening and welcome to the show. Let's just begin with the need of having the new kind of calculation for surrender value norms. What was the reason? What was earlier and what is the change?
Yeah. Good evening, Kavita. So as you rightly said, this new ruling has come from 1st of October. Now let's understand first why was surrender value, the change which came in, why was that required, right? So for that, you have to go back and understand what was the earlier rule. So from a customer's perspective, Kavita, a customer would never want to surrender a policy. Ideally, it's not in his favor, right? Because if you, the moment the objective is for a long term, 10, 15, 20 years. But if you surrender a policy in between, you lose coverage, you lose the premium. Also, it becomes very difficult for you to get another policy, and there are many disadvantages. So only in case of a financial contingency will a customer look at surrendering a policy. And earlier the ruling said if after the first year's premium which the customer has paid, and if he surrenders a policy, he gets nothing back. So he has to lose his entire premium. So from a protection of a customer's interest point of view, this surrender value ruling has come, which now facilitates, rather gives flexibility to the customer that even if he has to, based on certain contingencies, if he has to surrender the policy after the first year's premium, there will be a particular amount which will come back to him under the special surrender value scheme, right? And it also gives him the flexibility of portability. For example, if after buying a policy, if he sees there's a better policy in the market, this flexibility will allow him to port his policy to another insurance company. And on a broader level, this change is, I think, very positive. This will stop the act of mis-selling which used to earlier happen. So broadly, that's the reason why this particular surrender value rule had to change. And I think it's a welcome change for all the customers there.
So that's perfectly fine, and that's perfectly right as well. It's a welcome change for all the policy holder, for all the customers. But then I also want to understand the commission structure that has changed by the new rule of surrender value. What was it earlier and what has changed now, due to which policy holders will get more money when they surrender the policy?
Yeah. So we earlier spoke about the customer's point of view. Now let's look at this from an insurer's point of view, right? The moment there is a ruling wherein the refund is allowed, even after first year of policy, some amount of refund is allowed. What will happen from the insurance company's point of view is their profitability and margins will go down, right? That's the first thing which will happen, right? Secondly, they have a huge distribution network. Let's understand that how do insurance companies sell policies? The biggest network is the agents network, for which they pay a commission for every policy sold. So the impact which has come up, I mean, this impact is just a latest which has happened. LIC being the first insurance company to get this impact up, they have reduced the brokerage, the agent's commission from 35% to 28%. And without bonus, it has come down from 25% to 20%. So this was bound to happen, right? So this what does this impact to the agency network is? Now they'll have to work doubly hard to reach their targets to be a part of the $1 million roundtable conference. And secondly, what has changed is the insurance companies have also increased the commission percentage for the renewal of the policy, which was earlier 5%. It has become 7.5%. So on the hindsight, the insurers are trying to ensure that if the renewals has to happen on year-on-year basis, less of surrender of policies should happen. And that's why the agency's focus will move towards ensuring 100% renewal. And that's where the incentive of extra 2.5% comes in. And the third change which the insurance companies have got is they have increased the minimum sum insured from 1 lakh to 2 lakh, which essentially means from a customer point of view, you will be paying extra premium because that's the minimum threshold today.
All right, so Amjad, considering all this, the insurers' margins would decrease after the special surrender value. But then I also want to understand that higher surrender value will be applicable, or the beneficial payout will be applicable from the first year itself when you surrender the policy. So when you surrender in the first year, second year, third year, what was the rule earlier and what is the rule now in terms of benefits and payouts?
Okay, so Kavita, earlier, if you had to surrender a policy after the first year's full premium, there was absolutely nothing coming back to you. So you lose the entire premium which you had paid, right? After 3 years, there was a different threshold on surrender. So there's a different matrix which insurance companies follow. So after 3 years, there's a threshold of surrender value of 30%. After 5 years, it's 50%. After 8 years, it is 70%. So that was the percentage in which it was defined. It will still continue, but there'll be some change in that structure. Now what it says is, even after the first year's policy premium, there will be a surrender value which will come back to the customer, which was earlier zero. So that's how it's changed.
All right. Typically, what should be the reason why one might want to surrender the policy? I mean, mis-selling is definitely one of the main reasons, because, once people put in a lot of money and after a few years, when they are not looking at good returns in the particular investment, they feel it's a mis-sell. But apart from that, what should be the ideal reason to surrender a policy?
So as I said earlier, Kavita, usually from a customer's point of view, nobody takes a policy to surrender it. So there has to be specific reasons. One, you rightly said, mis-selling. In case of mis-selling, a customer should have a choice to move from one policy to another company's policy. But predominantly, there are two broad reasons why a customer would surrender policies. One is if he or she has a dire financial need and he needs some money back, and that's the last resort for which he has to surrender a policy. So that could be a genuine reason where there is a financial emergency and the customer needs to surrender the policy. Second is there could be a better policy in the market which was earlier not known. So portability becomes comfortable, and that is the reason why mis-selling will stop, right? Because now the agent will sell you the best policy which is there in the market rather than selling the policy which gives him the maximum commission. So these are three broad reasons why a policyholder might surrender a policy.
One last question. We are talking about the special surrender value being applicable from 1st of October. It doesn't matter when you have taken the policy, right? Or it is just on the policies issued after 1st October?
No, it doesn't matter when you have taken the policy. The ruling is applicable from 1st of October.
All right. I think that will be all. Thank you so much, Ranjit, for being on the show and helping our viewers. In fact, breaking down this entire special surrender value news for our viewers today.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.